Welcome to this explainer. Today, we're putting on the scrubs and acting as corporate coroners. We're stepping right up to the examination table, ready to dissect one of the absolute wildest and most devastating events in modern financial history. We're looking at the remains of a titan that just vanished. This is the autopsy of Enron.
In the year 2001, one of the most powerful companies in America simply disappeared. It really didn't happen slowly, and it definitely didn't happen quietly. In a total free fall so sudden and devastating, this company erased tens of billions of dollars and completely shattered trust across the entire financial world. You see, this isn't just your standard business story. It's a full-blown thriller about illusion, manipulation, and one of the biggest corporate scandals in history.
Just wrap your head around this staggering contrast. We're talking about a peak valuation of over $70 billion at the height of their power. And then, worthless. Literally worthless within a matter of weeks. So, we really have to ask ourselves, how exactly does a $70 billion giant just evaporate into thin air? Well, to figure out the cause of death, we've got to go all the way back to the birth of the company.
The rise of a giant. Let's make our first incision into the history here, because long before there was an illusion, there was a very real, tangible foundation.
So the Enron story actually kicks off back in 1985 through a merger between Houston Natural Gas and Internorth. At the helm of this new operation was a guy named Kenneth Lay. Now, Lay had this core belief that energy could be way more than just your standard commodity. And he was right, because by the early 1990s, Enron had totally transformed itself. It went from a regular, boring old energy company that just produced and delivered power straight into an absolute trading powerhouse. Fast forward to the year 2000, and Enron wasn't just successful, it was literally heralded as one of the most admired companies in America.
But the real catalyst for all that massive, explosive growth was a man named Jeffrey Skilling. His vision was, honestly, incredibly radical. He wanted to turn Enron into a market maker. Basically, this meant the company wouldn't just sell energy anymore. Instead, they'd trade natural gas, electricity, and eventually, pretty much anything that could be turned into a contract. Essentially, they started trading risk itself. And Wall Street, they absolutely ate this up. Investors eagerly poured billions of dollars into the company, and Enron's stock just skyrocketed. Act 2, the illusion machine. This is where things take a dark turn, where that brilliant trading powerhouse started morphing into something completely different. A terminal disease was taking root. Behind all that rapid growth, something really highly unusual was going on. See, Enron wasn't just reporting actual profits anymore, they were predicting them. They used a system called mark-to-market accounting. What they do is estimate the total potential profit of a deal and then just record that total profit immediately. Yeah, even if the actual cash from that deal wouldn't show up for years, or maybe ever. It's kind of like having a financial crystal ball that lets you claim tomorrow's unproven wealth today. Now, because of this mark-to-market accounting, on paper, Enron's profits were absolutely exploding. They looked like this unstoppable juggernaut to everyone on Wall Street. But the hidden reality? It was very, very different. If a deal didn't pan out, and honestly, a lot of them didn't, those massive losses weren't clearly reported. Instead, the company would frantically make new deals and whip up brand new projections to cover up the bad ones. The illusion just kept rolling. Enron wasn't merely growing, it was actively manufacturing its own success out of thin air. Act 3, the hidden debt. Of course, manufacturing all that success leaves behind a massive trail of real-world financial toxic waste. So where did they hide it all? Let's open up the secret trapdoors of Enron's accounting department. To keep up this massive facade of endless profitability, Enron desperately needed to hide its mounting problems. And incredibly, they found a way to make billions of dollars in real debt just vanish from the company's public balance sheet. They utilized these highly complex financial structures called special purpose entities, or SPEs. This was the ultimate magic trick that made their huge liabilities completely disappear from the public sight.
And get this, they gave these SPEs the weirdest, almost whimsical names. LJM, Chuco, the Raptors. Now, on paper, to any outside observer, these entities looked entirely independent from Enron. But in reality, they were deeply, intricately tied to the company. They were basically the shadowy dumping grounds for all those bad deals that the mark-to-market accounting had painted as massive successes.
So who exactly was pulling the strings on this complex financial shell game? Right at the center of it all was Andrew Festo, Enron's chief financial officer. It was a glaring, massive conflict of interest. Festo was managing Enron's corporate finances with one hand, while secretly running the very SPEs used to hide the company's losses with the other. It was a structure so dizzyingly complex that even seasoned Wall Street analysts couldn't really wrap their heads around it. But the end result was super simple. Enron's debt disappeared into the shadows, and their reported profits just kept magically climbing.
Act 4. The cracks begin. But, a body can only sustain a disease for so long before the terminal symptoms start showing up. By the summer of 2001, the illness finally became visible.
In August 2001, things took a drastic turn. The main architect of Enron's radical vision suddenly stepped down, with practically no clear explanation. Why did Jeffrey Skilling suddenly resign? This was a massive, waving red flag. The markets got extremely uneasy right away, sensing something was deeply wrong. But the real, devastating shock was still on the way.
2 months later, in October 2001, the truth finally started to bleed out. Enron reported a staggering, massive loss of $618 million. Almost overnight, that perfect facade of an invincible profit machine cracked wide open. Investor confidence didn't just waver a little bit, it began to completely and totally collapse.
And then came the fatal blow to the whole illusion. Shortly after announcing that massive loss, Enron came out and revealed it had actually overstated its earnings by nearly $600 million. The crystal ball of mark-to-market accounting had completely shattered. Investors finally started asking hard, direct questions. And terrifyingly for Enron, they were questions the company could absolutely no longer answer.
Act 5. The collapse. Once those trapdoors were finally flung open, gravity took over. And let me tell you, it took over fast.
The descent was just a rapid-fire panic. Step 1, the stock price, which used to soar over $90 a share, plummeted to less than a single dollar, all in just a matter of weeks. The panic spread like wildfire, with investors rushing to sell whatever they possibly could. Step 2, the credit agencies stepped in and immediately downgraded Enron's debt to junk status, completely cutting off their financial life support. And then, Step 3, the inevitable. On December 2, 2001, Enron formally filed for bankruptcy.
To put this into perspective, at the time it happened, this was the largest corporate bankruptcy in American history. That massive $70 billion giant we were talking about at the start of this explainer, officially dead on the table.
Act 6. Aftermath. So what was the final cause of death? And who exactly pays the price when a giant falls this hard? Let's sift through the wreckage in our final chapter. The investigations that followed were intense, and the executives who orchestrated this massive fraud actually faced real legal accountability. Let's look at the fates of those 3 main architects. CFO Andrew Fastow, the guy who built those hidden SPEs, pleaded guilty. Jeffrey Skilling, whose radical market-making vision really kicked this all off, was convicted and sentenced to federal prison. And Kenneth Lay, the founder who oversaw the whole era, was also convicted, though he passed away before he could actually be sentenced. But look, the real tragedy here isn't found in the boardrooms or even the courtrooms, it's the human toll. The consequences of this collapse were just utterly devastating for everyday, ordinary people. Thousands of employees suddenly lost their jobs out of nowhere, and worse still, so many of them lost their entire life savings because they were heavily invested in Enron stock. Entire retirement funds were literally wiped out overnight. The core trust between corporations, employees, and the public was deeply fundamentally shattered. And that right there is exactly why understanding these systemic failures is absolutely crucial for us as focused learners.
Enron's collapse really wasn't just a failure of a bad business model, and it wasn't even just about money. It was a complete failure of ethics, a failure of oversight, and above all, a failure of truth. This autopsy exposes how incredibly easy it is for perception to be manufactured to completely overwrite reality.
Because in the end, Enron didn't just fail as a company. It exposed the terrifying fragility of the very financial systems that we all rely on every single day. So, I want to leave you with one final, vital question to think about. How dangerous does it become when everyone is making so much money that no one bothers to question the story? Really think about that. Thanks for joining me for this explainer. Keep questioning, keep learning, and I'll catch you next time.